Imagine this. You wake up, make coffee, open your investing app, and the screen glows green. The market is up again. Financial TV is cheerful. Your retirement account looks stronger than it did a month ago. For a few seconds, something in your chest loosens. You feel a little smarter, a little safer, maybe even a little vindicated, like you made the right call by staying invested. Then real life begins. You stop for gas and stare at the receipt. You check the grocery total and feel that familiar tightness. You remember the rent increase that just hit, or the mortgage rate you still cannot make peace with. And that tiny moment of comfort suddenly feels ridiculous. The screen tells one story, your actual life tells another. And that is exactly where most people start comforting themselves with the wrong conclusion. They see a green portfolio and quietly decide that things must be getting better. Maybe not everywhere, but at least for them, enough to exhale, enough to stop worrying so much, enough to believe they are at least partially on the right side of the divide. This video is about that exact mistake, not the market, not politics, not abstract macroeconomics, your mistake. The private little story you tell yourself the moment the line on the app goes up. I'm invested, so I'm probably okay. That sentence sounds reasonable. In 2026, it is quietly becoming one of the most expensive sentences you can say to yourself. Because the market is not talking about your comfort. It never was. It is measuring whether large companies can defend profits, whether big capital can absorb shocks, whether the strongest balance sheets can keep compounding while everyone below them absorbs the friction. That is a completely different conversation from the one happening in your kitchen, where the questions are smaller, more personal, and much crueler. Can we still save anything this month? Do we push the dental work back again? Do we keep renting for another year? Do we stop pretending the credit card balance will somehow resolve itself? The market does not price those questions. It prices the durability of profits at the top. So when you read a rising index like a report card on your own life, you are already reading the wrong document. You have a brokerage account, a retirement fund, maybe a few tech stocks you bought during a dip. So you start to feel like you are participating in the upside the way the winning class does. But pause and ask the harder question most people avoid. If most of your survival still depends on wages, if most of your monthly spending still goes to necessities, and if on layoff, one medical problem or one surprise housing shock would force you to liquidate at exactly the wrong time, are you really standing with capital? Or are you still standing with labor, just with better branding and a slightly nicer illusion? A few shares do not move you into the owner class. They only make the divide feel less obvious for a while. That is why the illusion works. It does not need to make you wealthy. It only needs to make you feel slightly less exposed than you really are. You feel this pressure most clearly in the way inflation now works. It does not arrive as one dramatic headline. It comes back quietly in small decisions that slowly wear your position down. You stand in the grocery aisle and put back things you would have bought without thinking 2 years ago. You fill the gas tank and stay irritated long after you drive away. You open an insurance renewal or a repair bill and feel a small wave of dread before you even finish reading. One random medical expense, one school fee, one car repair, and suddenly the whole month has to be rearranged. None of this feels cinematic enough to call a crisis. That is the problem. It feels like normal adult life. And that is exactly how people slide backward without admitting they are sliding. Housing is where the self-deception becomes especially painful and expensive. Many people have started dressing helplessness up as strategy. You have probably refreshed Zillow more times than you care to admit. You looked at the monthly payment, closed the tab, and told yourself or your partner, let's wait 6 more months. You called it patience. You called it discipline. In reality, you're being pushed farther out. Renting longer, delaying ownership, losing years of equity buildup, and giving that loss a respectable name so it hurts a little less. Every extra month of delay is another month of rent instead of equity, another month your future self has to make up for. That is not patience. It is a quiet transfer of wealth away from you. Work offers the same quiet illusion. At least I still have a job. You have probably said it. It sounds responsible. But in 2026, it often means you have started redefining decline as stability. Thinner raises, weaker bargaining power, softer hours, and more fragile security no longer shock you. They have become background noise. Small business conditions are weaker, wage momentum is weaker, parts of white-collar work are already being thinned by automation and AI. Yet the mind keeps bargaining. It could be worse. That sentence is true. It is also how people train themselves to accept deterioration. Now here's the part most people do not want to hear. Your pressure does not automatically break the system. In some ways, it actually helps the system keep running smoothly. Slower wage growth protects corporate margins. Weaker households give large employers more leverage. Housing stress keeps more people renting longer and competing less for scarce assets. As long as you keep bending without fully breaking, the machine can keep calling the environment stable enough. Your restraint becomes their runway. Your exhaustion becomes their buffer. That is why the market can keep celebrating while your household keeps feeling thinner. Not because one side is fake, but because the pressure is being distributed unevenly, and you are very likely standing where the pressure lands first. That is why the little rush of relief you feel when the app turns green is so dangerous. It acts like emotional anesthesia. It makes you less honest about the rent, less alert about the debt, and less ashamed of how thin your real household margin has become. The screen does not repair your position, it simply softens your awareness of how exposed you still are. It gives you just enough comfort to postpone the harder truth that your household may still be weakening in every place that actually matters for long-term security. Not because you are foolish, because the illusion is emotionally convenient, and emotionally convenient illusions are usually the hardest ones to give up. So let's strip away the respectable language and say it plainly. Here are the 5 mistakes many of you are probably making right now. 1. Using the balance in your investment account as proof of safety while your real monthly costs keep rising faster than your income. 2. Treating continued employment as proof of strength while your bargaining power and real wage growth get thinner every quarter. 3. Calling being priced out of housing, waiting for the right time when you are actually being pushed into longer renting and lost equity. 4. Accepting tighter and tighter monthly margins as normal adult life, instead of recognizing it as structural erosion. 5. Mistaking partial exposure to the market for belonging to the winning class, the illusion that keeps you from fixing the places where you are actually vulnerable. That last mistake is the most expensive because once you believe you are already on the right side, you stop doing the uncomfortable work of repairing your real household balance sheet. And the bill for that mindset is not just psychological, it becomes financial, then structural, then generational. More debt carried longer, home ownership delayed longer, retirement pushed farther out. Lifestyle gradually thinned, a wider gap between those who truly live off capital and those who keep financing capital with their labor while telling themselves they are already participating. That is the bill, not just higher prices, a weaker future. So the next time the screen flashes green and you feel that small rush of comfort, don't ask the easy question. Don't ask whether the market is lying. Ask the painful ones that actually matter. Am I using the strength of assets to avoid admitting the weakness in my own life? Have I confused a rising line with rising safety? Am I quietly bleeding in every other part of my household while feeling proud of the one number that moved in my favor? And then sit with the question that may decide your next 10 years. How much of my future am I already trading away just to keep feeling okay when the screen turns green? That is the real story of 2026. Wall Street celebrates. Most people on Main Street quietly pay the price. And the danger is not that one side is wrong. The danger is that millions will use a rally to comfort themselves while their actual position keeps getting weaker, more expensive, and harder to recover. If that last paragraph hit you a little too hard, good. It probably means the screen has been telling you a more flattering story than your real life has.